Good afternoon, everyone. Today is Monday, February 3rd, first trading day of February. And did we have a dead cat bounce today? Sure felt like it, didn't it? After the market sold off hard in the morning, and actually even before that, the futures were down right from the beginning, even before the open. But then it came back. I'll show you what it looked like. Sure felt like a dead cat bounce, but this is a good example of why it's so hard to short anything in a secular bull market. You have to be very careful. That's not to say we won't have that opportunity, but today was not it. And for those that thought that it was going to be, you probably were in for a big surprise. But I think the best thing to do is to sit on your hands in volatile markets like this and wait for it to prove itself and identify a direction. So let's take a look at things. First off, I am not a financial planner. Anything that I say is for educational purposes only. I cannot make recommendations on what to buy or sell. It's up to you. You have to understand your own trading style, and past performance does not guarantee future results, of course. So let's take a look at what things look like today. First off, market bias went down slightly today, actually more than it has recently. It actually broke that trend line, that support line, I should say, right there. So it's coming down right now to the moving average line. But let's take a look. There's more reds than greens in the matrix today. And if we look at a few key ones, we'll look at the S&P. S&P, you can see right here, opened down here, closed up here. Remember, if it's an open candle, that means the shade is up. So it opened at the bottom and closed at the top of that open candle, much like this one. Whereas this one opened at the top and closed at the bottom. It's a closed shade. But we're sitting right in the middle of the range right now, just slightly or right at the 50-day moving average, a little below the 21. So it is reversion to the mean. I'll show you. This will make it really clear. So if we look at this with the Keltner channels, you can see pretty clearly it's right in the middle. Reversion to the mean. So tried to go down and then bounced all the way back. Open right there, sold off in the morning and came all the way back again. So actually we'll look at there's the 10-minute chart right there. So you can see right there, big, huge gap down in the morning. Try to make a recovery, didn't quite get back to the open or the close from Friday. And then right at the end of the day, started selling off again. So does that mean it's going to continue? Well, we don't know. You can see the big volume at the end of the day doesn't really mean anything. It's just market makers rebalancing their books. So don't think that just because there's big volume and that last 10 minutes was down, that it's going to continue to go down, because that may not be the case. However, it doesn't look great. So that is a dead cat bounce right there for sure. Now we don't know until we see, what happens tomorrow, whether there's going to be any follow through on that. So if we look at the NASDAQ 100, looks kind of similar. There's the 10-minute chart, looks just almost exactly like the S&P, doing the same thing. If we look at Bitcoin down here, Bitcoin actually had a bad day in the morning and then came all the way back and closed above its 21, both the 50, all of its moving averages actually closed above all of them today. So Bitcoin came back strong today, actually went back above the open. And Bitcoin trades 24/7. So this actually is going to continue to move. This 10-minute chart should continue to move. As we go along, we'll take a look at that again later. So right now it's at 102. Well, that was the high. 1019, 1018. So almost 102. You can call it 102. 106 is the key. 106 is what we have to get through. So US dollar screamed higher in the morning and then sold off all day long. Just continued to sell. This actually is a good opportunity for me to answer a question from a subscriber. They asked me, what do I mean by a black candle? So this, you can see black candles on this US dollar chart, quite a few of them actually. But what a black candle is, it means that it gapped higher at the open and then it sold off during the day, but it did not close below the previous day's close. So it stayed, or the previous day's low in this case. So it did not close below the previous day's low. So this one right here is a good example. So that's what it means. If you see it on a, let me see if I can find, I'm going to actually look at, I'm going to look at the Magnificent Seven because I think there were some black candles on that. Let's take a look at those. Not that one. Not that one. Let's see if there's any at all out there. There's lots of red ones on Apple. There's a black candle right there. So that's Meta. Meta reported on the 29th. So that was the day they reported. And this is the thing to look at, watch for on black candles, especially right when they report earnings. So this means it gapped up, it opened up here, closed lower, but it did not close down at the previous day's close. So that means it showed weakness during the day, but still showed strength from the previous day. So the thing to watch for black candles is that normally this is profit taking and potentially some short covering, but mostly it's profit taking from people that bought way back here. They think that's enough. They've start to sell some of their shares, so it actually moves down during the day. The thing to watch is to see what it does the next couple of days, because this selling might continue into the next day, which it did a little bit. And then it could reverse and start going higher. Once all those people that are looking to take profits are done, then the new buyers step in and push the whole thing higher again. So sometimes black candles are actually a good thing. You just have to watch them to see what they do the next day or so. Usually it's a catalyst like earnings in particular. If it happens in the middle of a trend, it doesn't really mean anything. But if it happens near the top, especially right after earnings or some other catalyst, then it's probably a good one to watch. And again, see, here's a black candle at the bottom. That doesn't mean, that's in the middle. That doesn't really mean anything. This is one at the top over here, and it did not follow through to the upside. So not only did people sell during the day, but the next day it opened lower. So that's why you can't trust it initially, but you have to watch it for the next couple of days to see what it's going to do. Lots of red candles on NVIDIA. There's a little one there on Tesla. I think here's a good one right here. So there's Netflix. So that's earnings right there. Earnings was 121. Actually, this after the close right there was earnings. It gapped up, opened higher, sold off all day long. So these are all the people that said, okay, I've had enough. I'm taking my profits. I think I've had a really good run on Netflix, and that's good enough for me. So they take their profits, and then it closes at the low. The next day it opened and at the same place, opened at the low, or the previous day's close, and then buyers stepped in, so it started moving higher. Now, in this case, it did not go down below the low, and more importantly, it did not close the gap over here. So that is a sign of a healthy stock. So now it's moving sideways through that period, and I will bet you that Netflix probably has a squeeze. I'll take a look. I didn't have my squeeze charts ready for this, but I can set them up pretty quickly. This is Stock Charts' new platform, ACP. We'll take a look at them on this, and we'll look at Netflix. No squeeze, but I bet you it's going to start one here pretty soon. You can just see how it's going sideways right there. So if we go back to Netflix here and we look at it on John Carter's squeeze, there is not a squeeze, and actually it's going to take a while. So the Bollinger Bands have to squeeze in, and the reason that they got so wide is because of that big gap up. So this will have to go sideways for quite a while in order to get a squeeze like this bright green right here. That's in a squeeze right there when it goes sideways like that. This is going to take a while. So you see right here where it gapped up, probably earnings there, went sideways, very similar to this. Then it created a really pinched squeeze right there. That might be what this is going to do again, but it's going to take a while. So you might have to wait another week or so. But that's what a black candle looks like. Great example right there. So when you see a black candle, wait the next couple of days. If it starts moving up, especially right away, that's healthy, very healthy. If it goes down the second day, that's okay. If it goes down the third day, then these alarm bell should be going off. If it closes the gap, then it probably is going to break down. It's probably a failed breakout. But that's what a black candle is. That's what it means. All right, let's get back over here and take a look at what else do we want to look at? We'll look at bonds. Somebody asked about bonds. Bonds are trying to make a comeback. There's a black candle right there. So opened higher, started to trade lower. It's right at the 50-day, 200 days way up here. For those that get my newsletter, and if you don't, you can get it for free right here on breakpointtrading.net on the website. Just click on this little box right here, and it will bring up the newsletter. And at the very bottom of the newsletter, I put this chart in. TLT, that's bonds, 20-year bonds. 2-month net fund flow. That does not look healthy, does it? That's huge outflows out of bonds. So unless something significant happens where people want to move back into safety right now, and this is probably a little delayed, so it's probably starting to tick a little bit higher right now. But that huge outflow right there, pretty much most of last year, actually starting probably beginning of last year, bonds have just been awful. So I would be very careful with TLT and with bonds, with anything that you do. All right, let's take a look at the, let me close these first, and then we'll look at the dashboard and see what's going on. Here's the dashboard. Next. Right here. Okay, so there's the big sell-off in the morning, and does that look like a dead cat bounce? I could put a little dead cat right there. That is the definition of a dead cat bounce right there. Dead cats, when they drop from a pretty good height, they bounce pretty nicely, but they don't usually stay up there. So we'll know, I think, tomorrow and later this week. Now, there's still a lot of earnings coming out, and I expect the earnings not to be that bad. So the next couple of weeks, we've got earnings, and that's going to probably prop up the market. We'll see. So there's what things look like today. The VIX, we'll look at the VIX in a minute. That's important. There's bonds. So 20-year tick a little bit up. There's the dollar is doing great. Commodities, gold went up today as well. There's gold, had a good day today and hung in there, stayed up there. Oil, kind of very volatile for oil today. And crypto, of course, Bitcoin sold off at first, but had a really strong end of day for Bitcoin. Okay, so let's look at the sectors for the day. All of the consumer discretionary technology, the aggressive sectors are at the bottom, except for communication services, which is right in the middle. That's where internet and Google reside. And the ones at the top, energy, utilities, healthcare, consumer staples, those are all defensive sectors at the top. So that is not what you want to see for a market that's trying to rebound. It might confirm that dead cat bounce that I mentioned. So the industry groups, we've got discretionary, communication, technology, energy, materials, staples, financials, and utilities. Quite a mixture, quite a big mixture on the industry groups today. And the top 10 list, which I update these every Sunday normally. So this reflects the newest list, and Noodles and Company actually is breaking out. That's only $1.60 stock. So that's starting to break out right there. That's interesting. It actually, in the last couple of weeks, last 2 weeks roughly, went from basically 60 cents to $1.60. So almost a triple in 2 weeks. Interesting. So let's look at the next level. See, there's HIMS, there's Brinker. Brinker had great earnings. There's MicroStrategy. Looks very similar to the rest of the market. So sold off in the morning and then came all the way back along with Bitcoin. Fubo, interesting. Disney is making noise about acquiring Fubo. What else do we have? Go one more level. Costco. It's in the third level. Costco's doing great. And then Constellation Energy trying to make a comeback, but didn't even get above last week. The worst of the list, Redwire. Not too bad. CRNC, that's breaking down, it looks like. So there's Tesla. Tesla's in the bottom 10, bottom 20, probably. Peloton continuing to go lower. Eaton looked like it was going to try to break out, but it's going the other way now. WGS, which has been in the top 10 for almost a year, it was up 2,600% last year. But now it looks like it's heading the opposite direction. So that's one I would not be holding on to that one, I don't think. All right, what else? Oh, I know. Somebody asked me, and I should have had this set up. Somebody asked me, do I prefer to use the Thinkorswim squeeze or the stock charts squeeze? So here's the squeeze on stock charts, and this is free. So both of them are created by John Carter's company, Simpler Trading. And let's see. Let me log into my account real quick. Sorry, I should have done this in the beginning before I started. But I'll show you the difference. And I actually prefer to use Thinkorswim just because it is the pay version. So it offers you a little bit more nuance than the free version, but the free version can work just fine, especially for those that are just getting used to it and want to try to understand how to use it. The other nice thing in stock charts is that I can create scans using the squeeze, which I can also do in Thinkorswim, but it's just a little bit easier in stock charts. All right, let's see. Let's see if I can find. Let's do a scan over here. See if I can find a squeeze, something that's in a squeeze. This is a scan to the downside. Intel. Nope, not quite. UPS. Not exactly. Yeah, these are looking for the histogram to be going below zero. So it's just beginning its downtrend. That's what that scan does. Let's try another one. Here's a daily squeeze. Let's see if that one gives me anything. One stock. Okay, so there's a squeeze right there. So it's been in a squeeze for 2 days, BRNT. So keep that in mind, and I'm going to put it up on my in my Thinkorswim chart, BRNT, and I'll show you the difference. Okay, so here's Thinkorswim. So there's stock charts right there. Here's Thinkorswim. This is a weekly and just pretty much just like this. There's a daily on the left and a weekly on the right. Here's a daily on the left and a weekly on the right. Now, what you'll notice here is on stock charts, it only gave me these two red dots down here. You can just barely see them. These two red dots, whereas on Thinkorswim, it's given me two black dots, which is the prelude to the two red dots. So it's just a different intensity, let's call it, of a squeeze. So it goes from black to red, and then yellow and you very rarely see yellow. There's a yellow over here on the weekly, right there, where it broke out the next week, significantly went higher. But this is the difference between the Thinkorswim squeeze, which actually gives you a little bit more information, or the stock charts squeeze, which just shows you the two red bars. So you can see them right there on the left. two red bars are 2 days in a squeeze, whereas down here it's 4 days in a squeeze. So that's the difference between the two. I actually like the Thinkorswim a little bit better, but either one can work. Just keep in mind that if you see a squeeze on stock charts, it may have already been in one for a couple of days before it got to that point in stock charts. So, okay, so that answers that question. One more question was, is it time to get into TZA? So TZA, that is the 3x inverse of small caps, or the Russell 2000, think of it. So if the Russell 2000 starts going down, this is going to go up 3 times. Similar to TNA as well. So you can see today, because the morning gap down, then this one gapped up. That's what it's supposed to do. It's supposed to go the opposite direction. And that's what it did. And the 5-day is just getting ready to cross the 21 right there. So it might be the start of something. But again, you don't know until the market can really give you a direction. And this is the difficulty in trying to short or use the inverse ETFs in a secular bull market like we're in right now. It can give you a dead cat bounce and fake you out very easily. And I think that what's going to determine that this week is what happens with earnings. So on my website, you can click on the upper right, you can click on the earnings button, and we can look at NASDAQ 100 because there's not too many of them. So this is upcoming earnings. See Palantir right here after the close, Palantir. Hang on 1 second. Let me see what they're doing. Going up, so up almost 20%. So Palantir must have had good earnings. So that's going to help the market tomorrow. AMD tomorrow after the close. AMD has not been a great stock. Let me see if this little button here works. Yeah, there you go. So Palantir closed at 83. It's at 100 right now after hours. So up almost 20%. So Palantir had good earnings today. So this is a way that you can look at the earnings right on my website. Right up here it says click here for current earnings, and that's a way to do it. So earnings are going to make a big difference this week. I think that will determine what that dead cat bounce, how dead the cat is, basically. Couple of other things I want to show that I've added to the site for those that are subscribers. On the portfolios page, I put these dividend stocks in at the beginning of the year, 3 different strategies basically. This is a dividend aristocrats right here, and then I ran this scan against all of those, and then dividend champions, and it describes what these are, and I ran the scan against the dividend champions, and then Vanguard high yield, same thing. So at the end of every month, I will put what the status, the performance of each of these are. So I filtered these by different things, one by dividend yield, one by 12-month performance, and one by 12-month technical ranking. And you can see the technical ranking for aristocrats turned out a little bit better in January. For dividend champions, basically they were all the same. And for Vanguard, they were exactly the same stocks. These other ones up here have different stocks. The filtering actually creates a different list. And the list, if you just click on this button right here, you'll actually see the list of all 3 of these. And then this shows you the year-to-date results. But this is the final results right there. I just put them on the website. And you can see down here, this is the one that did the best. Vanguard high yield, dividends 7.5% for January. Once we get to the end of February, I'll start putting in an annualized number in there too. But so far, those are looking pretty good now. Doesn't mean they will all year, but right now they look pretty good. The other thing I put on here is there's a MTS or market timing strategy over here that basically uses a weekly view of the VTI. VTI is a total market index that includes all of these things: the Dow, the NASDAQ, the S&P, the Russell 2000, and all of the other stocks that Vanguard tracks. So it's a pretty much the whole market. And the strategy is based on the weekly. So the weekly right here, this button actually shows you the weekly chart. And you can see here's where the primary trend began. There was a brief period where it was out of the market for 1, 2, 3, 4, 5, 6 weeks. And then there was a signal to get back in right there, and it's been in ever since. And even today did not issue a sell signal. So that is the long-term trend. You can see right now, based as of today, it's returned almost 41%. It started the trend on 11.3, which was this entry right here. If it hadn't been for this little period, it would have started back here in March of 23. So this is October of 23, and it has not given a sell signal since. So for those that want to be in for the long term, this is one way you can do it. It'll show you what the trends look like. It gives you some ETFs down here if you want to play them: the triple, the double, the S&P, the NASDAQ, and the Russell 2000. And then when it flips to short up here, when it flips to cash, that means just move to the side. When it flips to short, that means you can use the inverse ETFs and make money even as the market goes down. But during a secular bull market, that does not happen very often. The one below it is the daily chart. So the daily chart is a much faster moving one, so you'll get a lot more signals. Now on the daily chart, I do not put the exit signals. I only put the entry signals. And that is meant for people that missed the original entry back in November of 23, but still want to ride the long-term trend. These are the points to get in to the long-term trend. And then everyone has to make their own decision on when they want to get out. But what I've done is I have calculated the exits based on when it closes below the 21-day moving average. It happened right there. This one here happened right there. So it was out for 4 days, basically, and then back in again. So there's a lot more signals on this one. The other one, the signal, it's been a year and a half, basically. But this one, there'll be a lot more signals. However, I do keep track of starting back on the primary trend of 11.3. You can see right here, the cumulative medium-term performance since 11.3. And I calculate all of those entries and exits for this daily chart. And you can see it's come in at 37.4% going back to the same period. So yes, you'll do a little bit better just by staying in. Of course, you've got long-term capital gains to consider as well. But you can do fairly well just by tracking this as well. So that's what that MTS strategy is all about. And there's some charts down here if you want to look at some of these, just to take a look what they look like. But this basically is updated every day, and this performance indicator right here will change every day. And then when things start to go south, this will go to cash at the point where it makes sense to get out. The daily will go to cash more often than the weekly. The weekly has not gone to cash since November 3rd. So that's what that's all about. It's on the website, and anybody can track along and watch that. So I think that's all I've got for today. Oh, I want to show you the VIX. There is one more thing. So let's take a look at the VIX, because it was very volatile, seemed very volatile today. But let's take a look and see if it really was volatile. So the VIX chart is down here, I think. Yeah, right here. So here's the dark version of the VIX. You can see it opened above 20. So that's bear territory. Bears in control above 20. Bulls in control below 17. That's this green line here. So we opened up here, and the VIX came back into the neutral zone. So even though the market initially was concerned about the tariffs that were implemented over the weekend, they don't seem to be as concerned anymore, or they seem to be accepting it and integrating it into their considerations. So right now the market is in the neutral area for volatility. However, you can see the 12-month rate of change is certainly ticking up right now. So if that continues to go higher, that will not be a good thing. There's another way to look at the VIX over here. And that shows you, again, there's the green and the red lines. So you can see the VIX right now is starting to move higher. You can see when the red line crosses the green, which basically is the 5 and the 21 moving averages. This is the put call ratio. Put call ratio actually went down. Interestingly, went down today. You would think that there would be more puts being purchased, but does not seem to be the case. And then this is the S&P chart, and this is the 10-year Treasury down here. So 10-year Treasury ticked up slightly, but not as high as Friday. So that's been kind of tame. The VIX looks kind of tame. Even the put call ratio looks bullish to me, frankly. When the put call ratio gets really low, way down here. Oh, I'm sorry. Yeah, this is the S&P in the background. Put call ratio is the candles. So you have to be careful. Oh, I'm sorry. This is the put call ratio. This is the S&P. Yeah, these things are out of alignment. I got to fix that. This is the S&P up here, and this is the put call ratio down here, this line. So it is very low. So that means it is very bullish. This is the 10-day moving average. So that's extremely bullish. There's mostly calls right now. That's usually the time when the market starts to move down. So it's counterintuitive, and that is what's beginning to happen right now. So we'll keep an eye on that as well. I'll clean this chart up for the future. We'll look at it again probably tomorrow. So tomorrow for Technical Tuesday, I think I'm going to do Fibonacci's. I had some questions about Fibonacci retracements. So I'll show you what those are and how I typically use them. So stay tuned for that tomorrow. All right, that's it. Thanks everyone for watching. Please like and subscribe so we can keep this channel going. And I appreciate everyone's time. Take care.